Hello, and welcome to the demo portion of Chapter 14, which deals with dividends, right? In Blackboard, I posted the Chapter 14b problems. So, in order to make this as beneficial as possible, it would be a great idea as we go through each of these journal entries to pull that document up, whether you print it, whether you have it on your screen as we go through the journal entries. Whichever you prefer is fine. Again, the key is follow along, and as we go through, I'm going to kind of give you some pointers and things like that. So, we're going to work on problem 14-1b. Again, this coincides with your problem 14-1a for homework. So, the problem tells us that on January 1st, 2017, Chen Corporation had the following stockholders' equity accounts. They have common stock. Their common stock has a $5 par value. They have 200,000 shares issued and outstanding. Their paid-in capital in excess of par common stock account is $200,000, and the retained earnings has a balance of $840,000. Now, this is very important. We always got to start at the beginning, right? What's the beginning? Well, the beginning is January 1st, 2017. That information that they give us, the common stock, the paid-in capital in excess of par, and the retained earnings, remember, those accounts are all permanent accounts, meaning they don't close, right? Think of them as buckets. And as the company conducts business over the years, they use each of those accounts to carry that balance forward, okay? So we always got to start at the beginning. In this case, the beginning is not zero. We're not starting fresh, per se. We're starting at the beginning of 2017, and because they have a balance in each of these accounts, especially retained earnings, that means that they've been in existence for a while, okay? So, they give us a list of transactions, and then what they want us to do is journalize the transactions. They want the closing entries for net income and dividends. Then the second thing we have to do is we need to enter the beginning balance, post the entries to the stockholders' equity accounts. They give us a hint. They say, note, additional stockholders' equity accounts, or open additional stockholder equity accounts as needed. Okay, that's fine. And then the last thing they want us to do is prepare the stockholders equity section at December 31st. Obviously, that's going to be 2017. Okay, so on January 15th, they declared a $1 cash dividend per share to stockholders of record on January 31st. It's payable February 15th. So on January 15th, guess what they did? Declared a dividend. That's our declaration date, right? January 31st, they tell us that the stockholders of record on January 31st are going to get that dividend. That January 31st represents our record date. And then the payable date, that's the date that they pay it on. That's February 15th. So if you do not know those dates, if you didn't know the definition until I just gave them to you, you need to go back and study those. Okay, put them on a note card, study them. Okay, I guarantee record date, declaration date, payable date, definitions, probably going to be on the exam more than likely. Okay, so let's go ahead and do our journal entry, right? So first we got to date it, and that's January 15th. Whenever we declare a dividend, okay, hopefully you've studied, you've watched the videos, and you know, I have to debit cash dividends and I need to credit dividends payable, okay? So that's the journal entry. Cash dividends, and we're going to credit dividends payable. Okay? If you don't know that, you got to learn it. Put it on a note card. Hey, and this is never going to change, right? When a company declares a cash dividend, I have to debit cash dividends and I need to credit dividends payable. Okay? Always, always, always. All right? As long as you can remember that, you put it on a note card, you study it, you memorize it, you're going to be fine. Okay? That's the key. All right, so now we got to figure out what's a dollar amount on this, right? Well, it's easy. We know that on the declaration date, they said we're going to pay $1 dividend to everybody that has a share of our stock. Great. That's awesome. How many shares are outstanding? Well, in order to determine that, all you need to do is just look at the problem. And they tell us that we have common stock, $5 par value, 200,000 shares issued and outstanding. That outstanding is the key, right? That 200,000 outstanding. So we're going to multiply the $1 by the 200,000. So, super easy math. We're going to debit cash dividends for 200,000, and we're going to credit dividends payable, $200,000. Okay? Now, if we look, the next thing or the next transaction that they tell us is on February 15th. They actually paid the dividend that the board of directors declared back in January. Easy. So, always skip a space, right, between our journal entries. Please do that. For those of you that might be wondering, hey, what's the verbiage here? What's the explanation? Well, we declared a dividend, right? It's not that hard. What did we do? Well, we declared a dividend. Okay. Why did we do the journal entry? And hopefully everybody in unison is saying, because we declared a dividend. And I'm going to be specific and say cash dividend. Okay. Now, skip a space. Always skip a space. February 15th, right? What happens? Well, we paid the dividend that we declared back in January. Notice that the record date, and if you don't know this, put on your note card. Hopefully you do. We never, ever, ever make a journal entry on the record date, right? That's just for us to know who owns the stock, who owns that stock on that date. That's who's going to get a dividend check from us, okay? So, I paid the dividend, right? Paid it. What's the journal entry? Well, the journal entry, whenever we pay a cash dividend, is we need to debit dividends payable. How are we paying them? Well, we're paying them in cash. So how do we decrease cash? Cash is an asset. Assets decrease with a credit. So I'm going to credit cash. Okay? For how much? Well, we declared a dividend, total dividends payable of $200,000. So obviously, that has to be the amount of the journal entry. Okay? Oh, sorry. Now, how are we going to explain this? What did we do? Well, we paid cash dividend. That's it. And we can also add a little more information. Paid cash dividend paid cash dividend, and I'm just going to say declared on January 15th, right? So I know that this journal entry represents us paying, or the corporation paying, the dividend that was declared on January 15th, okay? Skip a space. Now what's the next thing we do? Well, April 15th. We declare a 10%, or the board of directors rather, declared a 10% stock dividend to stockholders of record on April 30th. It's distributable on May 15th. On April 15th, the market price of the stock is $15 per share. Now, why is that important? And hopefully you guys are recalling from the lectures or the lecture notes that we have two types of stock dividends. We have a large dividend, or a large stock dividend, and a small stock dividend, right? What's the difference? Well, there's a threshold. That threshold, it's about 25, it's 25%, right? So we declared a 10% stock dividend. Is that a large stock dividend or a small stock dividend? Well, it's small. Why? Because it's underneath the 25%. Okay? Whenever we issue a small stock dividend, we need to remember, and hopefully you remember, we have to use the market value. So, if you didn't put that on your notes when you watched your video, when you watched the lecture video, note it now. Whenever we have a small stock dividend, and that small stock dividend is under 25%, we got to use the market value. Okay? So that's number one knowledge you got to memorize. You got to know. Okay? So, what's the journal entry? Well, this is easy. On April 15th, because we declared the dividend, we need to debit stock dividends. Okay. For how much? Well, let's think about it, right? First of all, how many shares of dividends are we giving out, right? Well, that's easy. We have 200,000 shares outstanding. On those 200,000 shares that are outstanding, those shareholders are going to get a dividend of 10% of the total outstanding stock dividends, right? So that means that we're going to have 20,000 shares of stock that we're going to issue, right? Because that's 10% of the total outstanding, okay? At what price? Remember, because it's a small stock dividend, we got to use the market value. So we're going to multiply that by $15, which they tell us is the market value. If we run the math, 20,000 times $15 a share, we end up with $300,000. Okay? Now, I have to credit. What am I going to credit? Well, let's think about this. I'm recognizing the fact that I have a stock dividends that's going to be payable, right? That's really what that is. Stock dividends, it ends up being, we view it as a payable account, right? Because we owe somebody stock. Okay. We then need to credit our common stock dividend account. Distributable, sorry. So common stock dividend distributable account gets credit. For how much? Well, we're issuing common stock dividends, right? We need to use that. Think of it as a liability account because we owe people stock dividend or owe people stock, shares of stock. We need to record it at the par value, okay? So 20,000 shares times what's the par value? Well, if we look at the problem tells us it has a $5 par value. So we're going to multiply that by $5. That ends up giving us a total of $100,000. There's a difference, right? Debits and credits do not equal. We need another journal entry. Well, obviously, we need to hit the paid in capital in excess of par account common stock. So I'm going to credit that. Okay? Really helps if you know how to type too. Sorry about that. Paid in capital in excess of par common stock account, right? For how much? Well, that's easy, right? We need to book the additional paid in capital in excess of par. How much of the dividend that we paid is in excess of par? Well, the market price is $15. Par value is $5. The paid in capital in excess of par has to be $10 per share. So I'm going to take 20,000 times $10 and the additional capital, paid in capital in excess of par common stock should be $200,000. Journal entries, debits and credits match. This is your journal entry, okay? Anytime you see you pay a stock dividend, that's the journal entry you got to do, right? The only difference is, or the only catch, is that you need to think, okay, is this a large dividend distribution or a small dividend distribution? 25% is our cutoff or our threshold. If it's small, we have to use the market value. If it's a large stock dividend distributable, well, then we just use the par value, okay? So, I know my buddy Danny out there is going to ask, Professor Bruce, what's the explanation? Well, what do we do? Declared a 10% stock div, and then I'm just going to say what date it was. That was on April 15th. All right, the more information we have, the better. Okay, skip a space. Now what are we doing? Well, if we see on May 15th, guess what we did? We issued those shares of stock, right? That stock dividend, we issued that. We paid that. So guess what? That's the next journal entry. You might be saying, well, hey, in the problem, it said, April 30th was our record date. Again, do we make a journal entry on the date of record? And hopefully everybody's saying no. Good. Okay, so let's look at May 15th. We issued the shares of stock, or the stock dividend. So what do? Well, we just undo pretty much what we did, right? What are we paying? Well, we're paying stock dividends. So my common stock dividend distributable account has a credit balance, right? I'm issuing that stock dividend. That $100,000 balance goes away because I'm paying it out. So I need to debit common stock dividend distributable for how much? $100,000. And I need to credit my common stock account. I'm paying it out at a value of that par value, right? So that's why I'm going to take the 20,000 shares, multiply it by the $5. That gives me the $100,000, okay? This is the journal entry whenever we issue a stock dividend, pay a stock dividend, okay? So all you need to do is just memorize this. Put it on a note card. Rote memorization. That's all this is, right? It's all recall. I know it's boring. The fun stuff gets to when we get to the fun stuff whenever we hit intermediate 1, intermediate 2, and start analyzing gap and all this stuff. I get it. Right now it's just simple rote memorization. And I remember when I was in grade school, really, grade school, junior high, high school, I hated rote memorization, right? Hated it. Why? Well, because I like to think I was smart, right? And I wanted to know why I was learning stuff, right? Why are we learning this? Well, we're learning this because we got to get you through this class so you can go on and study what you're really interested in, right? I know a lot of you guys are not accounting majors, and that's okay. We're just going to get you through it, right? So, and again, I know somebody's going to ask, hey, what's the explanation? Super easy, right? What did we do? We paid, or we distributed a stock dividend. So, distribute stock dividend. And I'm going to say declared on April 15th. Okay? All right. So let's look at the next one, right? The next one says on July. Wow. July 1st announced a 2-for-1 stock split. The market price per share prior to the announcement was $17. The new par value is $2.50. Whenever we have a stock split, and hopefully you remember from the lecture videos, we don't make a journal entry, right? No journal entry whatsoever, right? We will, however, make a note, right? We'll note it, okay? So we'll say July 1, what do we do? Well, we have a memo here. This is just the memo, okay? The memo was, or is, sorry, 2-for-1 stock split. We're going to increase the number of shares. Sorry, number of shares outstanding. How much? Well, it's going to be $440,000, right? How do I know that, right? Well, think about it. And just look at the T account. I'm just going to create a T account here. Center. Okay. For the common account, right? Remember, we originally had a credit balance of $200,000. Oh, sorry. We had a credit balance of $200,000. Then we issued 20,000 more shares, right? So that means we have a total shares outstanding at July 1st of, I'll just add it up, 220,000, right? So we now have our shares outstanding now are going to be the $440,000. How did I get that? Well, again, I took the 220,000 shares outstanding, and then I multiplied that by 2. Why? Because it was a 2-for-1 stock split, okay? I'm also going to note that this reduces the par value bear with me here. Okay. Reduces the par value to $2.50. Okay. How do I know that? Well, remember, we got to think back to the lecture videos and maybe look through your notes. And remember, what happens when we do a stock split? Well, we don't do a journal entry, but what happens is the number of shares that we have outstanding either increase or decrease, right? Depending on if we have a stock split or a reverse split. And the par value is affected, right? 2-for-1. So we have 220 outstanding. We got to issue double that, right? Because we had a stock split. What happens to the par value? It it cuts in half by $2.50. Okay? So, excuse me. The next journal entry we have, by the way, this is just a memo, right? And think back to Accounting 1 when we were dealing with returns and things like that. When we were buying merchandise, we were a merchandising company. We were buying inventory to turn around and sell to other people. If something was wrong with that inventory, we got a either a debit memorandum or issued a credit memorandum, depending on if we were the buyer or the seller. It was just a memo, right? That's what this is. Whenever there's a stock split, just memo it, right? You have to put a memo in just so that way I know you know what to do, right? And what do you do with a stock split? Well, you increase the shares outstanding, you reduce the par value, okay? So let's go back and look at the next journal entry. Well, if you see on December 1st, we declared a 50-cent per share cash dividend to stockholders of record on December 15th. When's it payable? It's payable on January 10th, 2018. So let's think back to accrual accounting, because that's what we're doing now, right? We got to accrue everything, right? So we're going to have a dividend payable. It's not going to be paid in 2017. It'll be paid in 2018. So what journal entry do we do? Well, basically, we do the same journal entry that we did up here, the first journal entry, okay? So we're going to kind of we're going to work through that, okay? So the first thing I need to do is say, oh, sorry about that. First thing I need to do is say December 1st, we issue a cash dividend. Okay. So I'm going to debit cash dividends. For how much? Well, how many shares outstanding do we have now? We have 440,000 shares. Times, what's the cash dividend? Well, it's 50 cents per share. I run those numbers. I see that I'm going to pay a cash dividend of $220,000. What's my credit? Well, my credit is dividends payable. It's a liability. When I declare a dividend, I got to recognize the liability. That's what we're doing here. So I'm going to debit, I'm going to credit dividend payable for the same amount, $220,000. What is my explanation here? Well, super easy. Italicize that. And I'm going to say, declared or recorded the declaration of dividend 50 cents per share. Okay? Now, so we're still working on problem 1, right? So if we notice, excuse me, on December 31st, we need to determine, or on December 31st, the company already determined that net income for the year was $250,000, okay? So we're still on part A, right? Journal the transaction, do the closing entries for net income and dividends, okay? How do I do that? Well, the first part should be very easy, right? Because we've learned this before, right? On, excuse me, December 31st, I need to close the income summary account, right? So we have net income. I need to close the income summary. So I close the income summary with a debit. Why? Because it's net income for $250,000. And I need to credit retained earnings for the same amount, $250,000. Why? Net income increases retained earnings, right? That income summary, that's my stop-off point. That's where we close all our temporary accounts, the income accounts, and all the the revenue accounts and all the expense accounts, right? So the next thing I need to do is I need to show that, or I need to close my cash dividends, right? So let's think about this, right? How many times did I hit cash dividends? Well, let's think about that, right? Cash dividends was 200, or let's come over here and let's create our T account. All right, cash dividends is a temporary account. We just use that as a holding place to show that we did, in fact, we did in fact declare cash dividends, right? So on January 1st, it was $200,000. And when else did we hit cash dividends? We hit it on December 1st of $220,000. Okay? So, I need to close my cash dividends account. It has a balance of $420,000. Remember, cash dividends decrease our retained earnings. Okay? Or let me rephrase that. Dividends, any kind of dividend, decreases our retained earnings. Why? Because we're distributing earnings to the owners. Who are the owners? Stockholders. Okay. So I need to close cash dividends, right? How do I do that? Well, it's easy, right? Retained earnings. Increases with a credit, decreases with a debit. I'm decreasing my retained earnings. So I need to debit that, right? I'm going to debit it for the amount of the account balance, which is $420,000. Okay? I'm going to credit cash dividends. For the same amount, $420,000. Okay? So, by closing this account, I need to post that closing entry. And I see that my cash dividend now is back to zero. So guess what? In 2018, that cash dividend account is zero, and it's ready to start recording cash dividends that are declared in 2018. Okay? The next account I need to close is going to be my stock dividends, right? Because the stock dividend account, excuse me, the stock dividend account is just like the cash dividend account. It's a placeholder, right? It's a temporary account, meaning we close it every year. And it's just to show that, yep, we acknowledge that we have in fact declared a stock dividend. So I want to go back and post these, or I want to post my transactions. So when did I debit stock dividends? Well, I debited on April 15th because I declared a stock dividend. And then if I look through the transactions, that's the only time within that year that I declared a stock dividend. Guess what? I need to close this account. How do I close it? Well, it's a dividend. It decreases retained earnings, so that means that I need to debit retained earnings. For how much? Well, what's the account balance? The account balance is $300,000. Okay. What account am I closing? Well, it's that stock dividend account. For $300,000. I'm going to go ahead and post this. Oh, sorry. Okay. So I see now that my stock dividend account has a zero balance. It is ready to start, or it's ready to go for 2018. It's ready to record any stock dividends that maybe are declared in 2018. Okay? So that's part A, right? Now we got to look at part B. Part B says post all these, right? Well, you really don't need to do that. Okay, I'm not going to require you to post everything. If you're unsure of what you're doing, it's a great way to go through it and post everything. If you don't, and you can work through the calculations as I'm going to do, that's perfectly fine. Okay. The key is you got to understand what we're doing. All right. So we're going to skip part B, posting, right? But now we need to prepare the stockholders equity section at December 31st. Okay. So what I'm going to do is I'm going to move over here. Okay. And I'm going to go ahead and create in proper form this section of the balance sheet. So remember, I just clicked 5 columns. It's an arbitrary amount. Okay, there's no set, it has to be this wide, whatever, at least for our purposes. Okay, just make it look nice and neat. That's the key. All right. So remember, what does the balance sheet, not the balance sheet, all financial statements. What does the header include? Well, it includes the name of the company. We're dealing with Chen Corporation. What are we doing? Well, this is what financial statement is this? It's the balance sheet. But it's a partial balance sheet, right? We're only doing the equity section. And what date is this? Well, it's December 31, 2017. Okay? So now what I'm going to do is I'm just going to merge and center kind of three columns here. And then I'm just going to click and drag. There we go. Okay. Now, for these cells, I want to make sure that I click wrap text. It'll make everything look nice, and I'll show you what I mean. Okay? So, please take pay very, very close attention to how we set this up. Okay? This is proper form, right? Now, you might be saying, what in the world are you talking about, right? Certain things are going to have certain headers, right? So certain things need to be left aligned, certain things need to be maybe indented once, certain things maybe need to be indented twice. Okay, so let me show you. So the first thing we're going to do, we're going to left align, make sure everything's left aligned first. What section are we doing? Well, we're doing the stockholders' equity section. So we're going to title it Stockholders' Equity. Okay. Now, what is stockholders' equity made up of? Well, it's made up of two things: paid-in capital, and it's made up of retained earnings. So the first subsection underneath stockholders' equity is our paid-in capital section. Okay. So indent once and say paid-in capital. Now, within paid-in capital, we have two accounts or two sub-accounts of paid-in capital. We have the capital stock, and then we have the additional paid-in capital. Okay? So the first thing I'm going to do is I'm going to indent 3 times, and I'm going to say, I'm going to list my capital accounts, right? Now, capital stock. Capital stock, okay? Now, normally, or it is possible, let's put it that way, that underneath capital stock, I might have common stock and I could have preferred stock, right? Unfortunately, in this problem, they didn't talk about preferred stock at all, and that's okay. So we're not going to have it, okay? So I'm going to indent this time 4 times, and I'm going to say common stock. What is my par value? Well, you might be saying, I know somebody's going to say $5, right? Well, it's not 5, right? We need to go back and look at what we did, right? So let's look through. Look on July 1st. We have a memo. We had a 2-for-1 stock split, right? What's the par value? $2.50. What's the shares issued and outstanding? 440,000 shares, okay? So that's what we're going to put here, right? Bear with me here for a second. Make sure that this this one right here, actually all these rows should be wrap text. And I'll show you why in a second here. Okay, so we have our common stock. It has a $2.50 par value. How many shares outstanding? Well, we have 440,000 shares issued and outstanding. Enter. And make this a little bigger. There we go. Okay. So now, again, we're dealing with the balance sheet. We do not have debits and credits, right? So please do not put, a debit here, a credit there, or, envision a debit and credit section within the balance sheet. Debits and credits only count whenever we're doing our ledger, right? And we're posting to, whenever we're posting to the ledger and when we're doing the journal, right? In the balance sheet, we need to know, does it have a debit balance or a credit balance? Okay, we have to know that, right? So, if we take 440,000 shares times times $2.50 per share, we end up with $1,100,000. Okay. Now, the next thing we have, the next account we have, is our additional paid-in capital. Okay, so I want to make sure this is left aligned. It needs to match with our capital stock. So I need to indent this twice. I'm sorry, 3 times. I apologize. That's 3, right? So underneath here, we're going to list all the accounts that we have in excess of par accounts, right? Normally, if we issued both common and preferred, we would have in excess of par common stock, in excess of par preferred stock, normally. In this problem, we didn't even touch preferred stock, right? That was last chapter, okay? Excuse me. So I want to indent 4 times. Make sure you wrap your text. And we want to say in excess of par dash common stock, right? So what is our account, right? What's our account balance? Well, we started off with $200,000, a paid-in capital, paid-in capital in excess of par, $200,000, right? That's what we started off with. That was our beginning balance. But then we added $100,000 to that account, right? April 15th, we had additional capital in excess of par. I'm sorry, that was $200,000, right? So we need to add that $200,000 to the original balance, which was $200,000. And then as we look through our journal entries, did we hit that paid-in capital in excess of par account? Nope. We only hit it that once. So to figure out our beginning balance, or to figure out our ending balance, we're going to take our beginning balance, $200,000, plus any time throughout the year that we actually hit that account, okay? Instead of posting, I'm doing it in my head, okay? So that's $400,000. So now, guess what? I've calculated what the total paid-in capital section is of the balance sheet, or of the stockholders' equity section. Okay, so I'm going to indent 5 times. 1, 2, 3, 4, 5. I'm going to type in total paid-in capital. Damn it. Okay. Paid-in capital. And I'm going to add these up. the 1,100,000 plus the 400,000 of additional paid in capital in excess of par, I get 15 or $1.5 million. Okay. Now, what is the second piece of stockholders' equity? Well, we know it's paid in capital, right? It's the retained earnings. So I'm going to indent twice here. 1, 2. I'm going to type in retained earnings. Now, what is my total retained earnings? Well, we know that we started off with $840,000. Okay, we know that. So I'm going to come over here and I'm going to create that T account, right? Just to demonstrate how this works. Once you get good enough, there we go, Merchant Center. You can do all this in your head, right? And what do you mean by that? Well, what I mean by that is I would remember that the beginning balance for this account was $840,000. And then we're going to go through and see, when did we hit retained earnings? Well, we hit retained earnings during our closing process, right? Net income was $250,000. That increased our retained earnings. We paid dividends, right? We paid cash dividends of $420,000. And we paid stock dividends of $300,000. Right? So to figure out what my balance is, I'm going to add up all my credits. Add up all my credits. And then I'm going to subtract all my debits. Oh, sorry. And I have a balance of retained earnings now or an ending balance of retained earnings of $370,000. So I'm going to plug that in. So now I need to figure out what is my total stockholders' equity section. Okay. So to do that, I need to indent 5 times. And I'm going to type total stockholders equity. And that is going to be the total paid in capital plus the retained earnings. And my total stockholders equity section is $1,870,000. Okay. By going through this problem, I gave you a lot of information, right? Kind of reviewed let me rephrase that. We reviewed how do we make up that stockholders equity, right? So if you don't know that, or if you didn't remember that, and this was kind of new, it shouldn't be new information, because we covered this many moons ago when we were face to face. But going back and kind of relearning, if you will, stockholders equity section, we have 2 major accounts, paid in capital and retained earnings. And then within those, within that paid in capital, we have really 4 accounts, right? We have 2 accounts. We have capital stock accounts, and then we have additional paid in capital accounts. Within each of those, within capital stock and within additional paid in capital, we will have 2 accounts, right? We will have the common stock at par value, and we'll have the preferred stock at par value. The additional paid in capital section also has 2 parts to it, right? It has the in excess of par common, and it would have the in excess of par preferred. Okay, so tune back in for our next video where we run through problem 14-2B. So thanks for tuning in, and we'll see you in our next video.